Welcome to 𝗙𝗃𝗘𝗘. In this video, I'm going to show you once again just how insanely powerful the signals generated by this one trading strategy really are. I'm talking about clean entries, razor-sharp accuracy, and massive reward potential that completely crushes the risk. This is not random trading. This is not guessing. This is the kind of system that, when executed properly, can seriously change your trajectory as a trader in a relatively short period of time. If you are trading stocks, then this strategy instantly becomes a strong, productive money machine working for you every single day. But if you are trading Forex or crypto, listen carefully, because now you are no longer entering the market like everyone else. You are entering the market together with the big players, the institutions, the professionals, the real market makers. And that means something very important. It means you are no longer in a small boat fighting waves. It means you are stepping onto an aircraft carrier, the USS Gerald R. Ford, a massive unstoppable force that moves through the market with power, stability, and dominance. And once you're on that ship, nothing can stop it. Now, before I openly break down exactly how this strategy works, before I explain the logic behind it step by step, I want to show you something first. I want to show you proof. I want you to see clearly, visually, and without doubt, how this strategy gives me entry signals with confidence, precision, and almost zero hesitation. Let's start with the first signal right here. What do? Nothing complicated, nothing fancy. I immediately enter buy at the opening of the next candle. Then I place my stop loss just below this yellow moving average line. That's it. And now, look closely. As this video is being recorded, price is still moving strongly upward, continuing its bullish trend with power. Do you realize what just happened? This highly profitable trade was achieved with a very small stop loss, tiny risk, massive upside. That's not luck, that's precision. Now let's move to the second signal. Same rules, same execution, no emotions. I enter buy at the opening of the next candle. Stop loss goes below the yellow moving average again. This time, the entry signal is formed by a fairly large bullish candle, but that doesn't matter. Why? Because the stop loss remains below the yellow moving average, still extremely small compared to the reward we're targeting. And what happens next? Price continues to push aggressively upward, maintaining the bullish trend. Once again, a clean, powerful trade with huge reward and minimal risk. Now pay attention, because the third signal is special. This is an extremely important case study, especially for beginner traders. Let's break it down together. Here I enter buy with the stop loss placed below the yellow EMA line. Price moves up, then pulls back and eventually hits the stop loss. The trade closes at a loss. But look at this carefully. The loss is very small, especially when compared to the massive potential this signal carries. But wait, this is where most traders get it wrong. Price then moves back up again and breaks above the yellow EMA. So what do? I analyze the market structure, and very clearly, the market forms a new higher low. That tells us everything. That breakout above the yellow moving average is not noise. It is a buy signal, and it must be managed properly. So I enter buy again at the opening of the next candle. Now, where does the stop loss go? There are two options. Option 1, below the yellow EMA. Option 2, if the distance between the entry and the EMA is too tight, I place the stop loss below the nearest swing low, right under the most recent higher low. And then, boom, price explodes upward with force, never touching the stop loss, not even once. Even if the stop loss had been placed extremely close below the yellow moving average, the trade would still survive and run cleanly. Then we move to the fourth signal. Same structure, same logic, but this time it's a sell. Once again, the stop loss is very small, while the reward is very large. And finally, the fifth signal. We enter buy right here. Stop loss, tiny, and boom, giant profit. This is not chaos. This is not gambling. This is trader DNA. Crazy, right? Now I'm going to rip this wide open for you step by step so you can master this exact same powerful strategy the same way I use it. No guessing, no mystery. You're about to see everything. So what do you actually need for this insane strategy to work? Only 3 things. That's it. Number 1, a moving average. Number 2, market structure. And number 3, a trend line. That's it. Too simple? Yeah, exactly. It is simple. And listen carefully. Almost every powerful trading strategy on this planet is simple. Why? because when a strategy is clean, logical, and easy to follow, you can stay disciplined. And discipline, real discipline, is the one thing that every successful trader on earth shares. No exception. Not one. All right, now we start with number 1, moving average. In this strategy, I use a 30-period exponential moving average. And I know what you're thinking. Why EMA? Why not SMA? Why not something else? Let me break it down, fast and clear. Here's why I use exponential moving average. Number 1, EMA reacts faster to price. This is the big reason. Number 2, EMA helps you avoid late entries in trends. Number 3, EMA works insanely well as dynamic support and resistance. Number 4, EMA filters market noise way better than you think. So let me be very clear here. EMA is not better because it's smarter. EMA is better because it adapts to reality faster. And in trading, the one who adapts faster wins. Now the next question, why period 30? I use period 30 because the market I'm trading respects it, not because it's magic, not because someone on YouTube said so, but because through market analysis, I found that price consistently reacts to the 30-period EMA. This number, 30, comes from a process of matching the EMA period to the behavior of the market. And this is important. The EMA period is not fixed. It can change depending on how the market reacts. Sometimes it's 20-period EMA, sometimes 30, sometimes 45, sometimes all the way up to 60-period EMA. So yes, you must analyze which EMA period the market respects. You don't guess this, you don't skip this, you analyze it. Now look right here on this chart. From my suitability analysis, I'm currently using a 45-period EMA on gold USD, 30-minute time frame. This step right here is critical. If you choose the wrong EMA period, your entry accuracy drops, your confidence drops, your results fall apart. You must understand this deeply, and you must execute it with discipline. This step is not optional. You do not skip it, because the moment you skip this step, you fail to become a successful trader. Now let's talk about the moving average rules inside this strategy. Like I said earlier, this strategy is extremely simple, but don't let that fool you. The real power comes from discipline. You must follow the rules exactly the way I'm about to explain them, because this is the most important secret behind why this strategy is so powerful. This is the reason why, even with a very small stop loss, your entries, whether buy or sell, can deliver massive profits again and again. Alright, here are the moving average rules for this strategy. Rule number 1, if price candles are moving above the EMA line, then in this strategy the market is classified as bullish. Rule number 2, if price candles are moving below the EMA line, then in this strategy the market is classified as bearish. That's it. Very simple. And honestly, even if you're completely new to trading, I'm sure you already know this concept. Now, let me prove to you just how powerful the EMA period selection is, exactly as I explained earlier using this chart right here. On this chart, I've already analysed and selected the EMA period that the market respects the most, the one that works best across this structure, and that is the 100-period EMA. And now look at this closely. When price is already above the 100-period EMA, notice what keeps happening. Every time price pulls back and touches the yellow 100-period EMA, it tends to move up again, over and over. This is not random. This is the core key of the moving average indicator, choosing the correct period for the right market and the right time frame. And remember, even though this looks simple, the accuracy is extremely high. When this is combined with market structure and trend lines using the specific rules that I'll explain later in this video, you'll quickly realize something very important. This is not just a good strategy, this is a seriously powerful one. All right, now this is where everything starts to connect. We've already talked about the moving average. Simple rules, clear direction, high accuracy. But here's the truth. The moving average alone is not enough. To unlock the real power of this strategy, we need to talk about market structure. This is the part that separates people who hope from people who actually understand what the market is doing. Now look at the chart right here. Forget indicators for a second. I want you to focus on price itself. In a bullish market, price does only one thing over and over again. It creates higher highs and higher lows. That's it. That's the structure. Higher high, pull back, higher low, then push again. As long as that pattern is intact, the market is bullish. period. And the moment price fails to make a higher low, that's when something changes. Now flip it. In a bearish market, price does the opposite. Lower lows, lower highs again and again. This is not theory. This is how the market breathes. Now, here's where this strategy becomes dangerous. When price is above the EMA and at the same time the structure is making higher lows, we do not fight that market. We do not guess. We do not sell. We wait for pullbacks and we look for buy opportunities only. Why? Because structure tells us who is in control. Now watch this part carefully. Price pulls back toward the EMA, it slows down, then it starts moving up again. Before entering, I ask one question. Did the market create a new higher low? If the answer is yes, that pullback is not weakness. That pullback is fuel. And this is where beginners usually panic, but professionals get excited. Now, let's say price breaks below the EMA for a moment. Most people think, oh no, trend is over. Wrong. I don't care about one candle. I care about structure. If price breaks below the EMA but fails to create a lower low, then the bullish structure is still intact. And that means the move is likely a fake out, not a reversal. Structure keeps you calm. Structure keeps you disciplined. Structure keeps you on the right side of the market. And when you combine this with the EMA, now you're not just following price, you're following logic. EMA gives you direction. Structure gives you confirmation. And when both align, that's when your entries become clean, your stop loss becomes small, and your reward becomes asymmetric. This is why this strategy works so well, not because it's complicated, but because it's clear. And in the next part of this video, I'm going to show you exactly how we combine structure with precise entry timing, so you're not late. Not early, but right where the market wants you. Stay focused, because now we're getting into the real execution. Alright, now this is where everything gets even sharper. We've already covered the moving average, we've broken down market structure. Now it's time to add the final piece that brings everything together, trend lines. And listen carefully, trend lines are not about drawing random lines on the chart. This is where most traders mess up. In this strategy, trend lines have very specific rules. No guessing, no forcing lines to fit your bias. Now look at the chart right here. In a bullish market where price is above the EMA and structure is forming higher lows, we draw one type of trend line only. We connect the higher lows. That's it. Not the highs, not random wicks, only the higher lows that the market clearly respects. This trend line is not decoration. This trend line is support. Every time price pulls back and respects this line, the trend is still healthy. The moment price starts respecting the trend line again, that's the market telling you buyers are still in control. Now watch this. Price pulls back toward the trend line. Momentum slows. Then price starts pushing up again. This is not a signal to panic. This is a signal to prepare. Because as long as price respects the trend line and structure stays intact, we are still looking for buy setups only. Now flip the scenario. In a bearish market, price is below the EMA and structure is forming lower highs. So what do? We draw the trend line by connecting the lower highs, not the lows, the lower highs. That trend line now acts as resistance. Every time price rallies into that line and gets rejected, sellers are still in control. And as long as that happens, we do not buy. We only look for sell setups. Now here's the most important part. Listen closely. Trend lines are not entry signals by themselves. They are filters. They tell you whether the market is still healthy or whether something is starting to break. If price breaks a trend line but structure does not break, that is often just a temporary push, not a real reversal. But if price breaks the trend line and structure breaks at the same time, now you pay attention. That's the market warning you that control is shifting. This is why combining EMA direction, market structure and trend lines is so powerful. EMA gives you the bias. Structure tells you who's winning. Trend lines show you where the battle happens. And when all three align, your entries become obvious, your stop loss stays tight, and your confidence skyrockets. In the next session, I'm going to show you how we use trend lines to fine-tune entries, so you're not early, not late, but exactly where the move begins. Stay sharp, because now we're moving from analysis to execution. Now I'm going to show you exactly why this strategy has an insanely powerful ability to extract massive profits with a very small stop loss, exactly like the examples I showed you earlier. And the key is this, trend lines. But listen carefully, I do not use trend lines in every market condition. I only apply trend lines in very specific situations. And the strategy I use here is a trend line break strategy. Now, the big question is this: what conditions make a trend line valid in this strategy? Let's break it down. First condition: the trend line must be formed by a very clear market structure, so clear that there is no debate, no confusion, and no second guessing that it is a trend line, just like what you're seeing on this chart right now. Here, you can clearly see a bearish market structure formed by a sequence of clean, straight, lower highs. This is not messy. This is not forced. This is a structure that anyone, beginner or professional, can see instantly. And here's why this requirement is absolutely critical in my strategy, because all major traders see this, institutional traders see this, big players see this, market makers see this. When a structure is this obvious, every serious participant in the market is already aware of it. And yes, market makers are already positioning themselves, preparing for a big move that is likely coming. Everyone is watching, everyone is ready. That's condition number one. Now, second condition: the market structure formed in the first condition must create confluence with the signal formed by the EMA line. Let me make this extremely clear using a buy signal case, so there's zero confusion. In this buy scenario, when price breaks above the bearish trend line, price must already be above the EMA line. This is non-negotiable. If price breaks the trend line but has not broken above the EMA, then that is not an entry signal. No excuses, no almost, no guessing. Remember this: discipline is everything. This is exactly how the EMA line and the trend line work together to form confluence. One alone is not enough. Together they become powerful. And next, I'm going to explain market structure in deeper detail, because this step is absolutely critical. Without understanding market structure, you will never truly know who is winning the market, the buyers or the sellers. And if you don't know that, you're trading blind. Now we move into collaborating market structure. This is the final execution stage of my high accuracy entry system. And this step is absolutely critical, because this is the moment where we confirm whether buyers or sellers have truly taken full control of the market trend. To make this crystal clear, let's jump straight back to the signal and continue the analysis we've already been building step by step. Right here, price has successfully broken above the trend line and above the EMA line. So at this stage, based on the trend line and the EMA alone, the market is now classified as bullish. But here's the key thing you must understand. At this point, you cannot yet be 100% sure that buyers have fully taken control of this bullish move. This is still only the early phase of the movement. So what do I do next? I immediately analyze the market structure that has formed. And at this moment right here, you can see that price has not yet formed a bullish structure. The move is still developing. Then price continues into a retest phase, pulls back and starts moving up again. And now this is the moment. What do I see? A higher low. And that higher low is the signal that confirms the bullish trend has officially begun. And the action I take is immediate. I enter buy at the opening of the next candle right here. And my stop loss goes below the yellow EMA line. And then, boom, price moves up smoothly and powerfully, continuing the market structure of higher highs and higher lows that was already forming earlier right here on the chart. This is a clean signal, a clear signal, from a powerful trading strategy that is incredibly simple to execute as long as you stay disciplined. All right, so that this becomes even clearer for you, I'm going to continue to the next signal right here. Stay focused, because this is where everything starts to repeat with precision. All right, now let's jump straight into the next signal, this one right here, continuing the exact same analysis we just did. Here, price has already broken above the trend line and broken above the EMA line. So at this stage, based purely on the trend line and the EMA, the market is already classified as a bullish market. But just like the previous analysis, you cannot be fully confident yet that buyers have completely taken control of this bullish move. This is still the early phase of the movement. So at this stage, I immediately shift my focus to the market structure. And this time, this second signal is special because here price has already clearly formed a bullish market structure. What do I see? A higher low. And that higher low is the confirmation that the bullish trend is valid and established, and you already know what comes next. I immediately open a buy entry at the opening of the next candle, right here, and I place my stop loss below the yellow EMA line, and then boom, price moves up smoothly and cleanly, continuing the market structure of higher highs and higher lows that was already in place. Once again, this is a clean signal, extremely accurate, completely unforced. This is the result of a powerful trading strategy that is incredibly easy to execute, as long as you stay disciplined. Easy to understand, right? Yes, exactly. Because every great trading strategy must be easy to understand. The real challenge is not understanding it. The real challenge is discipline. You must follow every step, every rule, exactly as I've taught you in this video. Do not break even a single rule, because all of these rules are already fixed, already connected, and already part of one complete trading system. Break one rule and the system breaks. Follow them all and the strategy works. All right, now we push this forward to the advanced level, and listen to me carefully, because this is important. This strategy becomes more and more accurate the higher the time frame you use. Why? Because just like I said at the very beginning of this video, if you're trading stocks, you are literally plugging yourself into a money machine. A machine that's powerful, productive, and built to print over time if you know what you're doing. But if you're trading Forex or crypto, this is a different beast. You're not playing with random retail traders anymore. You're stepping into the market side by side with the real players, the big traders, the institutions, the actual market makers. Because on these higher time frames, this is where the real money war happens. This is where big traders and true market makers operate, extracting maximum profit, moving size, controlling direction, and shaping the market itself. That's why I truly hope you master this strategy properly, or even better, refine it, sharpen it, and make it even more precise over time. Because once you understand how this works at scale, you're no longer guessing, you're positioning. And as always, if you learned something new today, or if you want videos like this more often, make sure you subscribe, hit that notification bell, and share this video on your WhatsApp, Facebook, or X to show your support. I'll see you in the next one.